Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's November 7th. And I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. What a huge day yesterday. We all waited to see some incredible numbers. I know you probably stayed up late like I did and watch these developments on TV. After watching closely, pretty close to 4 hours, I realized something very, very important. The Duke Blue Devils are awesome. I don't know if you watched college basketball yesterday. Not talking about the midterm elections, but college basketball started. Kicked off last night. 4 of the top 10 teams. Kansas, my favorite team in the world, probably in almost any sport, played Michigan State and won. They looked great, had to hang on at the end. But Duke, I don't care if you like them or not, man, they smoked Kentucky by 34 points, which is insane considering Kentucky was favored to win that game. So Duke has a top 3 freshman in the country, along with the number 17th ranked freshman. That includes Zion Williamson. If you haven't seen this guy play, guys, definitely take a look. Even if you're not a basketball fan, incredible. He jumps to the moon, 42-inch vertical. He's 6'7", incredible. 285 pounds. Okay, you haven't seen him play yet? Just watch Duke. Unbelievable. They also have R.J. Barrett, Cam Reddish, just as good. For such a young team, they played incredible together, which is rare. Rare. If you want to see how rare it is, look at Kentucky over the past couple of years. They always get the best talent, but they can never get these guys to play together. They hog the ball. They don't move it. These guys are just unselfish and high-fiving each other. And watch, they were happy to see these other guys scoring. It was pretty incredible. You have no egos for these young kids. And, yeah, it was just, blew me away. Kansas also looked great. 2 amazing freshmen as guards, played awesome. Have some amazing transfers, including Dedrick Lawson, who is kind of like Dwayne Wade. Good scores, great passer, awesome rebounder. So very little weaknesses in KU. They have size, play great D, can shoot. Young guys with attitude. So welcome to college basketball, my favorite sport in the world. And oh yeah, there was something else that went on last night. There was a midterm elections. I was flipping back and forth between college basketball and channels like CNBC and Fox. But in a nutshell, there's really no surprises. If you're a Republican, you're claiming victory since you actually added seats in the Senate. If you're a Democrat, you're claiming victory since you took back the House. Yeah, flipping back and forth between Fox, which I was surprised to see them do pretty good reporting. It was a bias there, obviously, but they were talking about Democrats and how they have momentum and how some of them ran great campaigns. Again, it was definitely a bias, but it wasn't crazy. And then I'm flipping through, CNN and different tone. And it was political analysts saying, now that we have the House, we could subpoena Donald Trump's tax records and maybe able to launch numerous investigations against the president, maybe try to get him impeached. And look, I don't want to get political here. And I know you'll lose people on any side. Even there's actors that are just like refuse to talk about it because they're going to get blacklisted. I don't know if you read that story and stuff like that, which is true. You get so many people out there and everyone has such strong opinions, such hate. And I understand if you're a Democrat, listen, you're going to hate Republicans. You're never going to be a Republican. If you're a Republican, you're going to hate Democrats and never become a Democrat. I get it. It's fine. There's so much hate between the parties right now. It's kind of sad. But I will say this. After you win an election, like Democrats, right? They won the House. This is your chance to work with the president, to get things done, to get your agenda done. Some things, right? He has to work with you now. It's a great achievement. You guys ran great. Fantastic. You have a voice now. Okay, you did this. The people, just to benefit your constituents, right? The people who voted for you. And the first measures that at least a political analyst was saying on CNN is how they're going to attack Trump, make his life hell, try to impeach. And really? And when I look at things like this, is it about the people at all? Is it about us? I mean, we're voting for you guys. Is it about us, or is it just about destroying the other party? Might be a good idea to work together, bipartisan agreement for infrastructure, make our bridges, dams, water, all the infrastructure water underneath the ground. It's over 100 years old. I mean, that's safe for all Americans. Or is the agenda, hey, let's make Trump's life a living hell? I'm talking to you as investors here. Again, you're going to email me and say whatever you want, and I get it, right? It's very sensitive topic, and I get it. But this is about investors, because as investors, it's going to be total gridlock, which is going to be terrible for the markets. Usually it's good for the markets because you're forced to work together. But if you really don't care and just say, hey, we're going to destroy it, we're going to not approve anything, I mean, from an investor standpoint, that's dangerous. And now think longer term, guys, because say if the Democrats 2 years from now win the presidential election, still probably going to run the House, and I believe the Republicans will probably still control the Senate. Again, thinking farther out, who knows what's going to happen, but, right now, those are the odds on. Not the Democrats win, but, the Senate and the House. But if you're going through all these measures to destroy the president, what do you think the Republicans are going to do when or if you have a president elected and it's a Democrat? Instead of working together to make this country better, to make it great, to be for the people. And what are Republicans going to do? They're going to do the same exact thing, right? And it's been going on, but it hasn't been really this bad. I mean, we've seen it with other presidencies from both sides. If you have a Democratic president that's elected, what are Republicans going to do? They're going to do everything, his entire life, to find anything negative on that person and just launch investigations to launch investigations. No matter who you elect or what you do. And the Kavanaugh thing was sad. It was sad what happened on both sides. It's crazy. And again, looking from this investor's point of view, this is going to be a clear negative for stocks over the long term. If nothing ever gets done, with all the BS and fighting and the back and forth, what's going to happen? It's going to open the door for another outsider to become president in the future. Like maybe a Mark Cuban, a Mark Zuckerberg, Oprah Winfrey. People who have great business minds, and similar to Trump, but no, I'll be nice here, I won't curse, but know nothing. I was going to say D word. That really got me blacklisted off of iTunes. But know nothing about politics, military negotiations. And that's really going to happen because the people are going to be so sick of this fighting and you're seeing it. People are sick of it now. But the politicians, it's just about them. It's just about power. It's very dangerous for investors. It's pretty scary stuff. Now, usually or historically, the markets do very well after midterm elections. So we look at different sectors and what this means. I mean, energy should do okay, which certain parts of energy, got a great interview coming up, who's really going to dig into energy. Fantastic stuff that you're not going to hear. It's going to blow your mind, especially if you're an investor in any energy stocks. You're looking at energy in Colorado. Prop 112 was defeated, which would have capped the depth oil companies could drill at, which is under 2,500 feet. But it was defeated, which means, more oil and gas producers are going to spend more money to drill. In Mexico, a little different. I think Democrat won there, and they're usually more, free-spirited, and that could change. But overall, energy looks like it's going to do well, especially Colorado, since it's become a hot spot for fracking. But even outside Colorado, a lot of Republican initiatives will likely remain, which are energy friendly. But you're going to hear Democrats are going to talk up climate change, tougher carbon emission standards, and things like that. You're going to hear that, more of a voice. Look at healthcare companies, certainly going to get a boost. We have split Congress, which means Obamacare is going to remain intact, which is great for health insurance companies that make it a fortune. And also great for people who hate to work, right? Since they're going to get free healthcare on the dime of everyone else that has to work to support their families. So that's going to be really good. Going to provide healthcare to everybody. Kind of in a, I understand that, but at the expense that, I have to probably make $300,000 just to pay my healthcare costs for my employees at my businesses, and it's going to be raised 15, 20% a year going forward. It really hits home when you have your own business, especially a small business. It's crazy. But anyway, from an investment point of view, great for healthcare companies, great for the industry, not just insurance, but the industry as well. Look at technology. I think both sides are for more regulation, especially when it comes to privacy. So look at Facebook, Amazon, Google could continue to see pressure, along with Apple, who is just as bad when it comes to privacy issues, even though Tim Cook doesn't think so. He always goes after Facebook and Google and says, "Oh, these guys," And for me, it's just Tim Cook to say it just blows my mind. If you have Bluetooth in your car, it's almost like you have to use Apple CarPlay in order to use Bluetooth to play your music from your phone to your car. And it says, it has a disclaimer that shows up, right, in the little section in your car. And it says, Apple Pay, they're going to track your location, send data to third-party providers, all this stuff, right? So it's just funny when Tim Cook criticizes Google and Facebook about privacy issues, when Apple could be, if not worse, or at least on par with the Facebook and Googles when it comes to privacy. In the meantime, here's a guy that decided to no longer report unit sales on phones, on their iPhones. So you're an iPhone company, right? People want to talk about services and all this stuff. 70% of sales generated from that product. Again, they're an iPhone company. And all of a sudden, you're not going to report unit sales anymore? Hey, why wouldn't you do that? What are you hiding? Interesting. I've never seen so many free iPhones be given away. When you buy one and you transfer your number, you get another one. All the carriers, it was never like that. That's what happens when you're shoving 3 iPhones down your throat every single year, which it used to be every 2 years, every 18 months. It used to be one phone. Now it's 2, 3 phones that really don't have too many different features that you're shoving down their throat. So maybe, obviously they're expecting sales to slow, but it sounds like Apple's kind of at a top. You're selling your main product and say, hey, for the first time, or whatever, 10, 12, 15 years, how long we're not going to report unit sales anymore. It's just, use your common sense. Why wouldn't you do that? Obviously, they're expecting those sales not to be as great. Maybe they don't want to highlight how huge those margins are. They said they're going to put margins, but it's got to be massive if you're able to buy a new iPhone and get either a $700 credit or a new iPhone if you switch carriers, if you go from Verizon, if you go Sprint, or it was never like that with Apple. They never gave away phones. Now it is. Even the 8, they did that too as well. It's interesting to me. Anyway, I didn't want to get too much into that. But technology is not going to be impacted that much. Just expect more regulation on the FANG names from both parties. So it could be under pressure. Looking at banks, same things as technology. I don't see major impact due to the elections in either way, negative or positive. I can see any new regulations or, further easing of Dodd-Frank is really not in the cards. But, if you're looking at banks, great position. You're going to make more money due to higher interest rates. They're dirt cheap. Going to buy back loads of their stock. After the stress test, Citigroup's actually buying 30% of their shares, of their outstanding shares over the next 3 years. 30%. And they're raising a dividend. That's how much money, that's how much cash these guys have. They had big dividends, solid balance sheets, and the banks are stronger today than they've ever been in the history of America. And people want to debate that or whatever. Again, look at the buybacks, right? They weren't allowed to do this stuff because they took money, and some of them, like JP Morgan, were forced to take money during a credit crisis. Now, after the stress tests, and they passed with flying colors. Almost every one of them outside Deutsche Bank passed, over 30 of the major banks, the stress test. Now they could buy back a significant amount of stock and use that cash, which they have to keep enough money to survive a 30% market crash, minus 5% on GDP, 35% in a home price decline, and over 10% unemployment, right? Just put that in perspective. That never happened in the history of America all at the same time. Didn't even happen during a credit crisis or during a recession, the Great Recession. So it's when you see how much cash, and even during that moment, they said the maximum that these banks could lose if all those things happen are about $560 billion. Again, done a ton of research on this, and they have $800 billion liquidity. It kind of tells you that, look, they're not allowed to lend as aggressively anymore. They're just sitting on this money. And what they're going to do, they're going to say, okay, fine. Well, we're going to buy back a lot of stock, and their companies are already dirt cheap. I think it's a great buy, so I don't think it's impacted by the elections at all. But again, my biggest concern is these two parties refusing to do the right thing, work with each other, just because there's so much hate. But if they do work together, it could be a huge boost to stocks, huge boost to the economy. But I think we all know that they won't. So this is a big risk to the markets going forward, especially if the Democratic agenda is, 100% about impeaching Trump, making his life a living hell, launching investigations, instead of, hey, here's what we want to do. This is what we ran on. And now you're going to have to negotiate for us. And if you do that, we'll negotiate with you, which is pretty cool. But it doesn't seem like that's going to happen. There's going to be more tax and more garbage going out there. And honestly, that's not really going to be good from an investor's point of view. And I'll break that down more in future podcasts, how to play it, how to make money off of it. But right now, hopefully these two sides can really start getting along and getting things done together, because that's when the markets do best, when that happens. Now, moving on. An awesome podcast for you today, which includes an interview with one of mine and also your favorite guests, And that's Steve Koomar. So Steve's the editor of the Vigilante Investor, has over 25 years experience in the financial industry, worked at Goldman Sachs, specializing in derivative trading, bond trading, also a former portfolio manager of a very large hedge fund, which I won't mention the name of it, which is focusing on buying distressed mortgage-backed securities. So if you're not familiar with Steve, I had him on a lot, but he's a pretty smart guy. Just going to see in a minute. Going to talk about some interesting topics. China's emerging debt crisis. Few people are talking about. Wait till you hear what he has to say about this. Blew my mind away. Some of the statistics that I didn't know. He's going to give us an update on 5G. To talk about this over the past 4 or 5 months. And tell you what stocks are going to benefit the most and the quickest, because this trend is not really here yet. It's going to really start next year. But a lot of companies position themselves right now. Let you know which ones are buys, which ones are not. It's a lot of plays on this amazing, amazing trend that is going to fuel almost every technology trend you could think of. Big data analytics, AI, everything. IoT, autonomous vehicles, just faster speeds, faster internet, faster algorithms. So this trend's surreal. It's going to be widely talked about in January at the Consumer Electronics Show, which I'm going to attend. I'll give you guys a live update. And then Steve's going to talk about natural gas, seeing prices rise. And so he's going to tell you why natural gas looks incredibly attractive here, which I kind of disagree with. So it's going to be a great conversation from both of us. Steve brings up some amazing points. He's also going to say why oil, if you're long oil, you better be careful, because there's a good chance prices go lower. He's going to tell you a bunch of great stuff on these trends. More important, he's going to give you some great stock plays, how to play on his thesis on each of those. That's going to come in a minute. Then my educational segment. I'm going to talk about a sector that I freaking love right now. Yes, I said freaking. It's full of beat up names. A lot of these stocks have come roaring back lately. Not to their highs, but they fell 30% plus off their highs in October. And now they're up 10, 15%. There's a lot of great names. Fantastic. It's a sector that's not really being mentioned in the media as a place to look for alpha and generate alpha. But for me, it's a sector that I love. I talk about often, but right now I'm seeing more buying opportunities in this sector, probably than any other sector. And I got to tell you, it's probably going to surprise you which sector I'm talking about. Now, before I give you the name of that sector and share some of the individual stock plays that are going to benefit, let's get to my interview, the one and only Steve Koomar. Steve, thanks so much for joining us on the podcast again.
Oh, Frank, thank you for having me. It's always a pleasure to join.
Well, your Vigilante Investor issue, I mean, there's so many things that you're talking about that I found fascinating that I want to really get to, and certain topics that are just starting to be discussed. Again, we just had midterm elections and things like that. So not really a lot of market stories out there and what's going on. But one of the things that you're concerned about, which I haven't really heard people talk about, I heard about tariffs with China and what's going on, the market's coming down. But you're talking about an emerging China debt crisis. Could you elaborate on that and maybe tell us, is this factored in with the market down so much, or is this something that you see as a major overhang or a major problem going forward?
I don't think many analysts or people are focused that much on China's debt situation, but it's pretty bad, and it's easy to ignore it. But since 2008. China's total debt in their economy has increased from about 120% of GDP to 250% of GDP. That's an enormous increase. 250% of GDP for debt is a level that has typically triggered or led to a debt crisis in other countries. For instance, the U.S. hit that level in 2008. Europe hit that level. The European Union hit that level in 2008. So, very recently, that's been a level where if you have a catalyst that causes the economy to turn lower, it can turn into a vicious cycle that's kind of a classic deflationary depression like we had in 2009 in the U.S. and then you had in Europe, say 2010 through 2014. If you look a little closer at the data, and look at the private sector debt. And the private sector debt is important because the 250% of GDP that I was talking about that China hit, that includes government debt. Government debt may not be that important, particularly if it's denominated in your own currency, because a country can print money if it needs to and inflate away its debt problem and not really deal with that much of a crisis. But the private sector, consumers and businesses, they can't print money. They have to either pay that debt down or somehow have it restructured if they have a problem. And China's private sector debt since 2008 has increased from about 110% of GDP to 210% of GDP. That's a big burden. And the absolute number may not mean a lot, but 210% of GDP is what Japan hit in 1990 when its bubble got punctured. It's what Spain hit in 2008, and its bubble got punctured shortly thereafter. And in comparison, the U.S., which had the problem in 2008, which we know was extraordinary, it really peaked at 170% of GDP before it couldn't handle it anymore. Now, of course, there was a big catalyst in terms of the mortgage crisis that turned the U.S. down maybe earlier than it otherwise would have. But it illustrates that all you need is a bit of a catalyst here on China, and you're likely to have a serious contraction in their economy and a need for restructuring that may not be answered given their kind of need to maintain harmony in their economy. So yeah, I'm pretty concerned about it. I look at the 30% decline in China's stock market and the inability for it to bounce back much as an indication that maybe it's already started. Maybe this trade war has taken some of the air out of the economy there. And with a slowdown in growth, it will be harder and harder for companies and individuals to service the debt that they have. So we could be potentially already headed for a downward spiral. But it also could be that China can kind of stave this off for a little while longer. It's hard to say, but it doesn't bode well for Chinese growth going forward, and that does have some ramifications for certain markets in the U.S. and around the globe.
You know, it's interesting because as you said that, I had no idea that it was that high. Would you say 200 and something, 200 and percent of GDP?
It's almost 260% of GDP for overall Chinese debt. Wow. And the private sector debt alone is 213% of GDP as of the end of 2018. Or end of 2017.
And it's amazing because we talk about Greece, which is 180% debt to GDP, Portugal, 138, Italy, again, which is in the news like all the time, right? Saying, you know, Italy's in big trouble, and that's under 140%. Just put that in perspective. Now, let me ask you this. Based on GDP, based on their debt to GDP with China, and based on their market falling tremendously since February, since this whole tariff nonsense has been starting, what are your thoughts? It seems like they're being put under the gun, right? Where they won't say that they're going to negotiate something with us and say, okay, America's right? They'll never say that. But there's so many things they could do behind closed doors and ask the U.S. to have more companies produce stuff in China. There's millions of things they could do, even on a political front. Do you see this as a way? Because in the news, especially past couple of weeks, we've seen, China's willing to talk to the U.S. now, G20 and stuff like that. Is it more likely this deal's going to happen? Because it doesn't seem like China could play hardball for that much longer, especially when you're looking at that debt GDP ratio and you're looking at what's happening to their overall stock market. I hear from sources, well, they're not concerned about that, but there is going to be a level that you're going to be concerned at if debt GDP keeps rising and your market keeps crashing. Eventually, people are going to be like, okay, wait, we need to do something about this. Yeah,
I think that if they're looking at it rationally, they will make a deal, and it won't be something that they really like a lot, but it might allow them to make a soft landing for their economy. If there is a deal, the deal will be something that will still cause some slowing of of China's economy, and that creates some real big problems for them, particularly with the kind of debt that they have to service. But slowing is better than a collapse. And if they continue down this road that they're on right now, which is very confrontational and tit for tat on tariffs, supply chains are going to start to reconfigure to work their way around China, and China is going to have a real problem holding its economy at the levels where it is right now. And I think it would be looking at a real debt crisis coming on very fast. I think hopefully officials understand that, and hopefully they will make a deal. I was kind of surprised they haven't already made a deal, but it seemed like they made a bet on a government change in this election in the U.S. They got half of that, but not the whole thing. In that there's a split decision in the U.S. House versus Senate. The House is Democrat and the Senate's Republican. So it kind of changes the status quo, but it still maintains kind of Trump has the authority in the Senate to at least maintain the policies that are in place. So I think that right now is a good time for them to cut a deal, and they very well may, but we just have to wait and see.
Yeah, that's really interesting. Again, I love talking about this because I'm really into the tariffs. I've been talking about it on the show and saying that, listen, it's not going to be a concern to U.S. stocks. And then, over the past 2 months saying, hey, if China really wants to screw us, they can through rare earths and stuff. But seeing, just finding out more information and learning about, I didn't know that their debt to GDP was that high, which is incredible. But it just adds to the fact that maybe they might have to do a deal, which could lead to, a quick bump up. And a lot of these stocks are down 30, 40%. Or, again, maybe you want to wait till after that happens. I don't know. But it's good to know that, even if they do come up with a deal, there's still a lot of risk there. It's not automatic that their economy is going to bounce back and these stocks can bounce back. But
if they do get a deal, Frank, if they get a deal, these technology companies like Alibaba are going to do very well. They're going to have a great bounce. I think it's a great trade. But even with a deal, I think that there is the potential for an economic crisis unfolding over the course of the next couple of years, where Alibaba may not end up being that great of an investment over the next, over the intermediate term, the next 2 to 3 years. But yeah, after the kind of drop that these tech companies have had, they look pretty interesting right now. And if there is a deal, you're going to get a nice relief rally on them for sure.
No, it makes sense. So let's get into some of the other topics that I want to discuss, which is 5G. You talked about that in May, gave us Qualcomm. We actually put that in our all-star portfolio because we started tracking a lot of stocks that our guests are, the people that I interview are giving me, because there's so many great stock picks that, I think people were missing out on. So let me just try to create a portfolio and just highlight some of these ideas. And Qualcomm is one of them, which did very well. But talk a little bit more about 5G, because I know you think it's a great investment opportunity. From what I look at from my point of view, that there's different stages, just like we saw at 3G and 4G. And 5G is just, faster, super fast speeds and things like that. But it's almost like high definition television. Everything has to work out before it finally happens. And so I think you have the chips that start making they get the okay from, I guess it's the wireless providers where they start opening up these markets, and the tower providers and stuff like start building new towers. And then you have the chip makers, and then after the chip makers, you have the phone carriers like Apple and Samsung, LG. But we're not at 5G yet, right? All this is built, but it's coming. It seems like the phones that are out right now, they're going to be 5G capable. What I'm hearing next year, but everything's already built, is happening, which is when you want to invest in it. Is that accurate from the stuff that I've been reading, or do you see it like a little different? Because the trend's definitely here. You can invest in it now, but it seems like all this stuff is really going to come out next year.
You're right. It takes a while to get the products to where the infrastructure is in place, where you can sell the products to consumers that can utilize the speed and all the advantages of 5G. So there is going to be a lag in terms of those the new iPhones, et cetera, being 5G capable, and so it's going to take a little time for that all to play out. Right now, what's going on is the building of infrastructure. So, there's, Qualcomm does benefit some from that, but Nokia, Ericsson, companies like that they're the ones that are producing the very advanced radio equipment that's going to go in the new towers, and on the light poles and all the things that are where 5G antennas will be set up, and so that's something that could immediately get a lot of benefit. I have an infrastructure contractor, construction company, Mastech, in my portfolio. They have done very well over the last few years building out nat gas pipeline infrastructure and crude oil pipeline infrastructure in the U.S., but their biggest business historically is telecom infrastructure, and they do a lot of business with AT&T, and they're likely over the next couple of years to expand that backlog significantly as they build out AT&T's network or help AT&T build it out. So that's another one I think that looks really good from that standpoint. But ultimately, down the road, you're going to see, because of all these things, the speed, the low latency, and the incredible capacity. It's like 1,000 times more capacity for the system. You're going to see a lot more automation out there, and so the chips that will drive the automation, and also the chips that will service the cloud computing that the automation is likely to connect to, those sectors will see very nice growth over the long term. So you get a backup in those products and the companies that make those products. You probably want to take advantage of that and buy some of those stocks.
Now, and really quick with 5G, I mean, what I love about this trend is you have the AT&Ts and Verizons, which almost have unlimited spending, right? I mean, they do have loads of debt, we all know, and we know AT&T's really restructured their company to really focus on this, more importantly, because it's just data-driven and faster speeds and Time Warner and content being one of the biggest suppliers of information. Now they took over, Time Warner, which is content, one of the biggest providers of content and distribution. It seems like a good fit. It's going to take a while, but you have that to fuel this. I mean, you have these companies that have tons of money that they could spend. They'll take out more debt. Is it the best plays are you looking at infrastructure? Are you looking at maybe an AT&T, Verizon, even T-Mobile and Sprint? They say they have the fast speeds and stuff like that, but we know they don't have the best networks. Or is it more maybe tower providers, American Tower? Is it your infrastructure play, what you said, Mastech? Or is it maybe the Samsungs, the LGs and stuff? Or is it just the people with the technology, right? Listen, how many free names I'm throwing out here, like the Qualcomms and the Intels?
Well, the people with the technology are definitely going to be winners. They're likely to do the best. AT&T, Verizon have to buy their technologies. Anybody that adapts to 5G and uses 5G is going to have to buy their technologies. So they're in a very good position right here. And the infrastructure developers, companies like Nokia, Ericsson that make the radio equipment, companies like Mastech that put the towers up and install the infrastructure. Those companies are going to do very well because AT&T, Verizon, T-Mobile, they have to buy their services. They have to use these products. But the ones that I don't know so much about is Verizon, AT&T, T-Mobile, the actual owners of the networks. They're going to have a big capital investment and a lot of debt to pay back. And whether they make a high return or not, I think they'll make a return, but whether they make a good return for investors or not really depends on what the pricing power ends up being. And that's something that I just can't determine at this point. It depends a lot on how fast use is adapted and just really how competitive the space ends up being. It's above my pay grade to figure out that far in advance where they're going to be.
Yeah, no, it's cool. And guys, look, it's all about valuations. Maybe a company misses a quarter or so, and it can come down 15%. But yet, they're really into this, and this is a good, growth trend for them that they're going to get into, whatever company it is. But it pays to look at it because this trend is, the future of technology. I mean, every single thing, right? So if you look at big data analytics, AI, this is all gets fueled by 5G becoming faster. Algorithms going to be faster. So none of these major trends that everybody talks about, they could be great, but they're going to accelerate and change the world. But 5G comes in as we get faster speeds, so it's something worth definitely, looking into. And that's why I'm getting so many questions on it. Now, I want to move on because there's one more subject I want to talk about, which is natural gas. I mean, it's unbelievable, right? Because I think I went to a conference in 2013, and it was the Anadarko CEO that went up there, and somebody asked him about natural gas, and under his breath, he's like, we have so much natural gas probably for the next 300 years or something. I was like, I couldn't believe he said that. And I remember going to my podcast and saying that's how much natural gas we have. I'm very familiar with this industry. I've hopped on rigs all over, we're burning natural gas for free, but yet it seems like we weren't really, the stockpiles are incredibly low, and news came out that, hey, you know what, it's going to be pretty cold. We might have a cold winter, and we're seeing natural gas prices go up. How does this relate into, stocks? What, are you bullish on this trend? Because there's numerous ways to play it, but for me, it seems like it may be more of a trade because we do have a lot of natural gas that we can produce whenever we want. I want to hear your thoughts on it because I know you cover this industry well, and you have some unique thoughts on this.
Yes. we do have a 300-year supply of natural gas. There's a lot of it, and it's amazing how much natural gas is getting flared off. Because in the Permian, where they're going crazy with oil drilling, there's a lot of natural gas production that they just can't capture because they don't have the pipelines capacity to send it to the market. So there's a lot of surplus natural gas out there, but a lot of it's getting burned off. And it will take some time for that infrastructure to develop to capture some of that gas that's getting lost. But in the meantime, we've seen an amazing increase in U.S. exports of natural gas, both by pipeline into Mexico and by liquefied natural gas LNG terminals that are being built. And there's a lot more of these LNG terminals that are on the horizon to be built, and they're going to take a lot of the supply out of the market, and they continue to take more and more. And in addition to that, because gas has been cheap in the U.S. for several years now, very cheap, there have been a lot of manufacturing facilities that need natural gas as their feedstock, fertilizers, et cetera, that have located facilities in the U.S. so that they could access that cheap gas. That demand is going to be here for a long, long time. You don't build a new plant and then move to another country because gas gets a little bit cheaper later. They're committed now to operating these facilities in the U.S. So the level of demand between exports and industrial uses has picked up significantly, and so last winter we had a pretty normal winter, maybe a little colder than normal, and gas supplies really took a hit. I mean, the inventories went way down, and we finished with relatively low levels of inventory at the end of the winter heating season. We're going into this winter heating season with more than a 600 BCF deficit compared to normal, which is significant when you consider that last year the ending stocks were 1.2 BCF and 1.2 billion BCF. And so if you have the same kind of drawdown this year as you had last year, if you have an equally cold or maybe even a colder winter, you could be sitting at very close to zero stocks at the end of the winter heating season. And that would push supplies, or would push gas prices to very, very high levels. Now, that's a trade. Like you said, that's a trade. But there's an underlying issue here where we probably need to get significantly higher ongoing production. And you need to stimulate significantly higher ongoing production in order to meet all this export demand and all this industrial demand in the U.S. and still have the supplies available for residential and commercial heating needs in the wintertime. And you're not going to do that unless the forward prices start to rise in order to encourage more drilling of natural gas in some of these the big shale areas like the Marcellus. I don't think that means that gas prices they might go to $12 over the winter, but that would just be the spot price in the short term. What's more important is what happens to the prices for 2020, 2021, 2022 gas, which is still around $3 an MCF. And I think if you've got to get it up, probably up another dollar or so in order to encourage that kind of production increase. And if you get that, that'll be an enormous benefit to the companies out there that can increase production, and also the companies that haven't already put a big forward hedge on. And so there are a few companies out there that haven't hedged their forward production. Those companies are likely to really benefit over this winter if the rise in gas prices play out, and particularly if the forward prices rise out 2020 and beyond.
Now, what is some of those companies, without giving away anything in your newsletter that you recommended, but what is some of those companies? Is it more like the Anadarkos? Is it more like the Devon, who's natural gas as well, and also oil? And a lot of these natural gas companies have turned to oil, right? Because it's been such a weak market. But some of them still have a lot, Chesapeake, they still have a big, at least most of their revenues is derived, and most of their earnings derived from natural gas. What are some of the plays here that really make sense?
The one I like the best is Cabot Oil and Gas. They're focused only on the Marcellus. Their cost of production is so low because they're so focused on a very productive area of the Marcellus. Their cost of production is about $1 an MCF. So they make money under any circumstances, really, and they don't need to hedge their production forward, so they don't. So if you get an increase in gas prices, it's all going to come to the bottom line for Cabot, and they have an ability to expand their production significantly going forward. So that would be my favorite play. There's a few other ones out there that I like a lot that don't hedge as much, that are very focused in the Marcellus. I think that's the area for gas production that's gonna produce the greatest benefit. Although there's going to be a lot of other companies out there that do well. I'm kind of staying away from the companies that do a lot of crude production or that are increasing their investment in crude, trying to get a bigger mix of crude. Crude has done much better, has been much more profitable than natural gas over the last few years. But going forward, I think that gas is the gas part of the equation is going to be much more stable and have much more opportunity for growth. And at the same time, I think crude oil could be quite vulnerable. If you have a slowdown in the Chinese economy, crude demand is going to drop. And you also have that whole Iran sanctions thing going on. These sanctions are going to work really well, and they're being managed so that they're give enough waivers in terms of importers of Iranian crude to keep the oil prices stable. But ultimately, if they if they work, and I think they have a chance to work, a good chance to work, because these sanctions are the toughest we've ever seen. If they work, you could see a change of government in Iran, and if you got a regime change, you can bet that Iranian production would go right back to maximization really fast. The last time that happened, 2015, when there was the prior Iran deal that the Obama administration cut with Iran, crude prices dropped to $27. They're not going to go down that far again, but they could drop below 50. They could drop to $45. And if they did that, it would be very painful in the crude oil production segment. So I'm kind of trying to stay away from crude and focus on North American natural gas, where I see the supply-demand conditions very good and improving over the next few years.
No, it definitely makes sense. And you brought up, LNG as well, and it's amazing that there's so much demand for natural gas overseas, and we have such a huge supply. It's amazing how, I want to say, 2008, 2007, where we were creating all these liquefied natural plants. It's supposed to be import facilities, right, for us. And then, fracking went mainstream, and then we're like, oh, wait, they're export facilities now. But even with all this, there's just one, which is LNG, which is Sabin Pass. So it's Cheniere Energy, and then you have one other one that opened. I think it was like Cove Point from Dominion or something. I don't know if they're shipping out yet, but I know that's open. But there's dozens of more that are coming online probably over the next 3-4 years that they've already got the approvals and permits and stuff. But that's going to take a lot of supply off the market. I mean, you have people out there that are predicting there's going to be a supply shortage because we're going to be exporting so much natural gas. I don't know if I'm there yet, but it just seems, the fundamentals may be right. So that's why I like talking to guys like you, because I'll have a different opinion or whatever, but when you're throwing facts and different things, it just kind of makes you think, okay, what are the best plays? And the oil thesis makes sense, and natural gas. But it is going to be interesting, right, Steve? I mean, how often do we see oil prices or oil companies really come down, but natural gas prices do well, right? So it's kind of weird. It usually seems like the whole energy sector would go up or down, but that's what you predict is going to happen over the next couple of years, I guess, or at least the next couple of months.
It's not that I think oil is going to go down, but I think oil is vulnerable to the downside over the next 12 to 18 months. I think it's vulnerable to the downside. I think it could still go to 80, which would be great for a lot of people. But if it went to below 50, it would be very, very painful. And I think there's a decent chance of that. I don't see downside to North American natural gas right now. And I do see upside. So you have an asymmetric risk in natural gas. You don't have it in crude oil, and so that's why I favor natural gas.
That definitely makes sense, Steve. So listen, we covered a ton of stuff. Every time that you're on, I get tons of emails because not only you share your thesis, and even if it challenges the status quo that's out there, you always provide ideas for people to benefit. You provide facts behind your research, and I think that's why so many people love you. So keep up the good work. If people want to find out more information, how can they do that, Steve?
They can go to vigilanteinvestor.com, and if you have any questions, you can find my email address in the contact section. I'd be happy to answer any questions you'd have. Or you can find me on Twitter at VIInvestor.
All right, sounds great. Steve, thanks so much for joining me. I know how busy you are, and we'll talk soon.
You bet. Thank you, Frank.
Okay, guys, as always, great stuff from Steve. And from a personal level, this is why I love doing this podcast. Because there's so many anchors out there that I see and people that do interviews, like they have their own agenda. And if you challenge that agenda, they're like, well, and they just start shouting out like, you're wrong. And I love listening to the other side because Steve brought up some amazing facts on natural gas. Also some amazing things on China debt, like the debt GDP ratio. I didn't know it was that high. I mean, it makes me think where I'm like, well, they're going to play hardball, and that's what I'm hearing from my cut. They can't really play hardball, China. There's a reason why in the past couple of weeks they've come out and said, well, we're looking to talk to the U.S. Again, a million things could happen behind the scenes. China's going to say that they got the better of the deal. Trump's going to brag and say, hey, because of me, trade's better now, whatever. But behind the scenes, there's so much that could take place. But if you look at China with their market crashing, and that debt GDP ratio, it's kind of scary. Forget about, and I've heard this just through this podcast and people that I've interviewed who go to China a lot, who talk to brokerage firms and say, hey, they're not really concerned. They're going to get concerned. When you're seeing a market continue to crash, when you're seeing, a possible debt crisis, they're going to get concerned. And a lot of that could change if they come to the table and, they're able to negotiate, work out a deal with the U.S., but it's probably more likely to happen. Another thing that Steve talked about was natural gas. I mean, Marcellus. That's one of the first places I researched in 2008, 9. Remember, the shale boom was all about natural gas. And they found out, okay, how we could actually frack it and develop oil. And that's when the oil market, really took off. And a lot of these companies did well. And we became one of the largest producers of oil, which people thought that would never ever happen in the history of a country, as little as 15 years ago, 20 years ago. And it's amazing where we are now with a lot of this stuff. So, going back to the Marcellus and natural gas, I will say this, the LNG trend is fascinating because natural gas prices are a lot higher every place else. It's growing tremendously. I think it's growing by double-digit rate in terms of demand overseas because they're dying for natural gas. And now we have all these facilities coming up. I mean, LNG is the first one, Cheniere with the Sabine Pass. You have Dominion, right? Is another one that just, I believe it's 3-4 months ago. I don't know if they're shipping up, but I know it's operational. So you're going to see these companies lock in contracts from other countries. This way they get our natural gas and deliver it, LNG and stuff. But it's incredible when you see that trend because natural gas wasn't really on my radar. And yes, I saw the news and we all see the highlights of, okay, supply is dwindling right now. It's a little bit low. And that's why, expecting a colder winter. So natural gas prices are jumping up. I'm thinking more of a trade. It could be more of a long-term trend, especially as more of these facilities come online. They've already been approved. They've gone through the licensing and stuff like that. Now it's just building these things, which last time I researched, it cost between $8 and $15 billion to build these things. But once you do, I mean, the profits and the money coming in from this is just incredible. So, they'll build all on the coastlines, and they have pipelines already going to these places. So, again, a lot of infrastructure is already built. They just, it's going to be amazing when you see what happens with this trend over the next 5 years and how much natural gas is going to come off our markets. Because, think about it. If you could produce something and get 50% margins, 100% margins, even more in some places, and bring up a chart, go to Google and put natural gas prices around the world, and you'll see. Again, I've done tons of research on this stock, on these stocks and sector since 2007, 2008. But you'll see that chart, and you'll see natural gas prices really low because we got a lot of supply here. But look how much they're trading every place else, and it makes a lot of sense. It's going to take a lot of supply off of our markets, but just interesting stuff. And I love talking to so many different people, and they have different opinions than you, and you learn. It makes me want to dig in further. But that's how I find so many great ideas. And talking to Steve after I just interviewed him for 10 minutes or before the interview. And a lot of that filters into the all-star portfolio where You're finding new ideas from not just me, but from all these people that I interview, because some of them are fantastic ideas, and some of them don't work out or whatever. But it's nice to just include them in the portfolio, which is the all-star portfolio. But it's fascinating, and I just love my job when it comes to that, because I get to talk to someone brilliant all the time, and hopefully that comes across great for you. And that's what I care about, right? I always say the podcast is about you. It's not about me. So let me know what you thought of that interview at frank@curzioresearch.com. That's frank@curzioresearch.com. Now, let's get to my educational segment. The sector I was talking about early on, which I love, is biotech. I know, a little shocking, right? Got to surprise you a little bit. Built that up pretty good. But if you're looking at the biotech index, the XBI, one of the hardest hit during the October sell-off, falling close to 20%, taking down almost every stock in the industry. And now it's up about 5-6% from its lows, coming back, along with the rest of the markets. But there's tons of biotech stocks that look attractive right now. It's an industry, again, I follow. I tell you the rules, what to look for. If you're buying small cap companies with pipelines, partnerships, amazing technology. You try to buy companies that got killed. Maybe their phase 2 data wasn't that great, and maybe they just have to submit it again 6 months from now, and you'll see a stock decline 50-60%, sometimes below the net cash they have on their balance sheet. And it's a steal, because 6 months from now, if that gets approved, which we saw with kind of Aspirion Therapeutics, and this is a company I recommended. I'm going to give a couple away here, guys, because we're up a ton on these. So, if the Curzio Venture Opportunity subscribers don't get ticked off, sometimes I get emails, Frank, give it away, your stocks we pay. You're up a lot. People didn't get it where you bought it. Okay, so Aspirion is a company I followed for a long time. When it's high as 100, and then it was like 80 recently, it fell all the way to like in the 40s where we bought it, low 40s. And they're making a cholesterol-lowering drug, which is not a non-statin. And which is important, because anyone that does take statins realize that they hurt your bones sometimes, and they have bad side effects. And they came out with a study where the safety issues were a little bit higher than expected, and the whole market panicked and sold the stock from 80 to 40. And from looking at the data and following this company, I knew that they would come out. They came at the very open management. They were cool about it, and they said, "Listen, it was debt side caused, but it had nothing to do with our drugs or anything." And they came out with new test results, and it was fantastic. And the stock shot all the way up, and it's doing very, very well now. So, and I think it's going to go a lot higher. I mean, it's $58. I think we recommended it 43. Again, it was over 80 because investors got nervous about that phase 3 study. But now that that study's a positive, alleviating a lot of the risks and concerns. And right now, you have a cholesterol-lowering drug that focuses on lowering the bad cholesterol. That's really challenging some of the biggest drugs out there. So what does it mean? It probably means that this company is going to get taken over pretty soon. I wouldn't be surprised if Pfizer and Merck play in the 80s and 90s for this stock. And that's where the stock was trading not long ago. We saw that with IBM, right? Purchasing Red Hat. It was, a 65-70% premium, but Red Hat was basically trading at those levels 9 months ago, a year ago. So instead of buying this stock at 80 with the possibility that maybe you could have safety issues, now you don't really have those concerns, and you see a stock trading at 58, you can come in with a nice offer to say. But I think this company is a company that's going to get bought. I'm looking at companies, just so many amazing trends, right? It's the non-statin, cholesterol-lowering drug, DNA testing and analysis, gene editing, life sciences, immunotherapy, amazing technologies out there, guys. And we've seen immunotherapy. It's a sector that I covered very early on, where some of these stocks went up 6, 7, 800%. We also saw some stocks that I cover fall like 60, 70, 80%, because there's so many big guys getting into this industry, new technologies, and it's fascinating. It's just a feel-good story, immunotherapy, right? It's the first time that we have treatment for cancer in 80, 90 years, right? It's radiation and chemotherapy. I went through this with my late dad, who passed away from lung cancer, who was a smoker, but to see kids have cancer and their doctors say, hey, you have 6 months to a year, and then through immunotherapy treatments, they're alive for 3, 4, 5 years afterwards and cancer-free and remission. It's remarkable. So it's just remarkable how far we've come with some of these things. So you're looking at companies like BioMarin, BMRN, great pipeline, steady drugs, make money off of. It was 110, now it's at 95 and coming back off its lows. Alexion is 139. Was it 112 like a couple weeks ago? It jumped all the way to 126. Good companies that just got hit from algorithms selling because we triggered the 200-day moving average, 100-day moving average. CRISPR is another one. It's a company that got nailed, but that and Editas Medicine, which is EDIT. CRISPR is CRSP. And these names had a good bump, like believe it or not, in October, the Food and Drug Administration just said, hey, you know what? The first U.S. in-human study, we're going to actually go through with it. They said that, they basically said they blessed it and said, okay, we could do it now. CRISPR's, that's their gene editing therapy. So you look at CRISPR's down from 54 in September, and it fell as low as 32. It's 38. Amazing technology. Invitae is a company that I recommended for Curzio Venture. Again, don't get mad, I'm giving this away. Why? And this company is one of the best DNA testing companies in the world, which have the greatest tests, which test for the most stuff at the cheapest value for these tests, which they're basing their whole business model on scale, and it's working. It's incredible how many healthcare companies are actually covering these tests now. I think it's 160 million possible people that could take this test that are getting insured by this. So this is a company that I'm fascinated with. I recommend this company in my newsletter around 650, and it's over 15 right now. We took profits, just sold half of it for like 130% gain, but the stock is down from 18 to 15. It's fantastic. It's a company I love. But guys, start doing your homework on biotechs. They have momentum, which is good, but they're still kind of hated. They're still down a ton off their highs. The technology is fantastic. Their testing results have been very positive, and they're releasing more test results. They have great pipelines, a lot of these companies, and they're trading 20, 25% still, even though some of them moved up off their lows, off their highs for September, again, simply because the market sold off, not because their technology doesn't work or they failed a phase 2 or phase 3 study. And these companies are remarkable. And plus, you're seeing a lot of inflows to these ETFs. So that's saying the smart money is starting to pour into this. Again, it's going to come out of regular technology. And if you're looking, why is that happening? Well, if you're a hedge fund money manager, you make money by putting that money to work. You can't put it in cash because you're not going to generate money. So when you put it to work, technology, FANG stocks, everybody was overweight, completely overweight. Now that money's coming out, where is it shifting to? There's a couple safe havens, consumer staples, utilities. It's actually shifting over to biotech now based on, companies that track this, Merrill Lynch and things like that. So the smart money believes the sector is cheap as well. Start doing your homework on this industry. We have nailed lots of winners in our portfolio. We're very particular. I actually have a report for CVO subscribers that shows you exactly how to invest in this industry to lower your risk as much as possible and maximize your returns. But this is a sector I'm loving right now. You're probably going to see a lot more recommendations if you're a CVO subscriber, and even if you are a Curzio Research Advisory member, you'll probably see some more recommendations of large caps because a lot of those names have got hit as well. But the sector I love right now, guys. Definitely keep an eye on it. No one's really talking about it. All right, so STO, we're going to launch hopefully in a month from now. I'm getting lots of questions. If you're a credit investor and want to learn more, this is how we're going to raise money to compete with our competitors, some of the bigger players in the industry. We're doing it this way because it's cheaper on our end than just doing a regular private placement. 2, the liquidity event is a lot quicker for you guys, where this token will be locked up for 12 months because it is for credit investors, and that's the law. But once we do, that's going to be locked up, and your liquidity event's a year from now instead of investing in our company or private placement. And what's the liquidity event for you? When do you get to cash out? When do you get to get money back or whatever? Or, maybe you keep your stuff, whatever, but it's usually 7 to 10 years, which is a long time. So, the only way you cash out really, there's other tiny ways you could do it and be tricky, whatever. But to cash out, it's if we get acquired or if we do an IPO. And again, it takes 7 to 10 years. This is a way where you're going to see our token trade. We're going to be negotiating with exchanges over the next 12 months. A lot of exchanges and STOs are being launched. The first one, Open Finance, is coming out. You have T0's platform, I think in April, already approved, SEC regulated and everything. You're going to see probably more than a dozen exchanges come out. The STO market is the future of crypto. It's amazing. You're going to get equity stakes in these tokens. It's a way to fund money. It's a way to provide liquidity to real estate, to art, to collectibles. It's a fascinating industry. So much so I'm basing my company and my reputation on it. And doing this big capital raise, which, again, for credit investors, I wish it could be for everybody. That's the laws right now, which we have to do. To raise money in the U.S., but also you're going to be getting paid a 3% annual yield for the first 3 years, even during that lockup period, and you're going to get a significant equity stake, which is cool. And based on all the deals that I've seen, I haven't seen a better deal than this. And this is investor friendly. This isn't something I'm looking to make money on tomorrow. We're going to be locked up a year longer than everybody that comes in for this. And we're really, really excited about it because we're seeing a lot of demand with the partners that we're working with to create the platforms and stuff like that. And again, it's a fantastic deal. We're very excited, and that's really going to accelerate our growth process, which we want to bring our name and our brand to everybody and, level that playing field and have everyone have access to the stuff that I have access to and the investors I have access to. This way, hopefully we can all make money together. But if you're interested in that, credit investor, you can email me at frankcurzioresearch.com, getting tons of questions, answering. I'm going to set up a special STO thing and just, highlight the news and different events that I'm seeing, which is fantastic. But if you're interested, just email me, frankcurzioresearch.com. So that's it for me. Thanks so much for listening. And I'll see you guys in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.